Hi, and welcome back to another episode of The Real Return Show. Today we're joined by Mr. Randall Quarles. Sorry, Quarles. Mr. Quarles is the former Vice Chair of Supervision of the Federal Reserve, former Chair of the Financial Stability Board, and co-founder and Executive Chairman of the Synosia Group. He has also served at the U.S. Treasury, worked on international financial policy, and spent years in the private sector. Across these roles, he has been deeply involved in some of the most important questions in modern economics and finance, how markets, respond to crises, how banks should be regulated, etc. And I'm hoping we'll be able to get into some of those questions in our interview. Thank you so much, Mr. Quarles, for joining us today.
Yeah, thanks for having me. It's great to be here.
Thank you. So I kind of mentioned in our intro, the variety of roles that you've been in. So I think I would just like to kind of start out by you kind of going over all of those roles. So you started out at the Treasury, then the Financial Stability Board, or I guess then the Federal Reserve, then the Financial Stability Board, and before all of that in the private sector. Now you've returned to the private sector. So I'm curious as to what each of those roles entailed, what were the nuances between them, and what you kind of learned as you moved between them as well.
Well, while they're all involved with the economy, their principal focuses are uh, quite different. So the questions that they instinctively ask and that they're designed to respond to for any particular economic event are materially different. The Treasury, my first tour of duty in public service was, back in the Bush 41 administration, the very first Bush administration, as a sort of mid-level Treasury official. And then came back in the Bush 43 administration as an assistant secretary and then an undersecretary. And the job of the Treasury is both financial diplomacy and financial policy, and then also managing the country's fiscal position and the country's debt. So, uh, uh, the first question that the Treasury is going to ask is going to be focused on those issues. And the Treasury is also, of all of those places, the most intrinsically political. It's a branch of the administration. It has to respond to the political imperatives of the administration, both domestic and foreign, because financial diplomacy is really the preserve of the Treasury. So, all of those questions are then quite different from what the IMF would ask upon seeing the same macroeconomic event. Consider, a sharp rise in interest rates, just as an example. So the Treasury would say that's affecting the financial position of the country, the cost of our debt. How do we respond to that? The IMF would be saying, well, that's affecting the financial position of other countries, and particularly emerging markets, developing countries, whose financial positions may be fairly fragile. Which ones of those are likely to have trouble? What programs can we create in order to help them maintain their solvency? At an institution like Carlyle, an investment institution, the question is going to be much more micro. Which businesses are likely to have trouble given this significant increase in interest rates, and where might we deploy capital in order to address those dislocations in a profitable way? And at the Fed, there's a different set of questions. Both, how does this affect the path of monetary policy if long-term interest rates have risen this sharply? And how does it affect financial stability within the country? Because significant increases in interest rates, put pressure on the financial system. And then at some place like the Financial Stability Board, which is a global entity, what about the global financial system? And how would a sharp rise in interest rates in the United States affect the global system? So all of those are different initial responses. And in some ways, that's a source of resilience in the financial system, because you've got many different, institutions that are filled with highly competent people who are focused on different aspects of the consequences of a particular macroeconomic event. But it can also be a source of fragility, because there really isn't any one institution that is charged with responsibility for it all. And there are fragilities that can build up that aren't really within any of those specific mandates, at least initially, and maybe those can be missed. That's often where financial crises happen. Uh, and having sat in each of those different chairs, it has been, interesting to see, how that system works.
And would you say that each of them is like dependent on each other in some way, or would you consider them almost as independent bodies that could, stand by themselves to a degree, obviously?
So I wouldn't say they're dependent on each other. They interact with each other a lot. The Fed as a central bank, there's heavy activity among all the central banks of the world. They meet, every 6 to 8 weeks in Basel to discuss international economic conditions. Both the Treasury and the Fed, the Secretary of the Treasury and the Chairman of the Federal Reserve Board sit on the boards of the IMF in Washington. The there's regular interaction at all levels between the Fed and the Treasury, even though they have quite different roles, even in the domestic financial system. And there's, regular interaction between the official sector and the private sector. Large financial institutions, are regularly providing information to the official sector. The official sector is discussing developments with the private sector to understand how things look across a whole range of the financial system. So they are highly interactive, uh, but I wouldn't, they're also designed so that no one part is really dependent on the other.
Hmm. And then I kind of want to, I think we'll get into some of like your international roles too, so like at the IMF and Financial Stability Board. But there was one part in kind of your initial answer that I would like to zoom in on, kind of having to do with your role at the Treasury and the Fed. So, especially prior to uh, Kevin Warsh's, rise to being the chair of the Fed, like near kind of, the end of Chairman Powell's term, there was lots of, talks about, Federal Reserve independence and how the administration might be encroaching on that and stuff like that. And I'm curious as to, you kind of being both at the Treasury, which you said was more sort of politically like involved in having to align with the policies and like align with the president, and you also having a long time at the Fed. I'm wondering if you can kind of speak on the sort of like political involvement in both and why the independence of the Fed might be more important, or just your views on that kind of whole sort of setup.
Yeah, so my views on what we call Federal Reserve or central bank independence are a little eccentric. They're designed to make kind of both sides of that question unhappy.
Mhm.
In part because my training was as a lawyer, I think a lot about the constitutional structure of our government. I'm wholly persuaded that that constitutional structure really doesn't allow for so-called independent agencies. And just this morning, the Supreme Court, announced the decision that effectively overturns a Depression era precedent that had created the ability for independent agencies. And at the same time, in a kind of separate case that they connected and announced at the same time, they said, but that won't apply to the Federal Reserve, which we do think needs to have a certain amount of independence from the president. I, I actually think that you don't want an independent agency, not even for the Fed. What you want is an entity that whose decisions are resistant to short-term political control. And the Fed is a complex institution that was designed to respond to a range of historical and financial and political concerns that the country has had for centuries, really, uh, that few people really understand. It's not one entity. it actually was created to be 12 separate central banks.
Mm,
And those central banks are all private institutions. They are not government bodies. They are owned by the banks in their district. They have separate boards of directors that are selected by the shareholder, by those boards, elected by the shareholders, and those boards select separate CEOs, all of which are part of the private economy. There's a board in Washington that consists of 7 people that are appointed by the president and confirmed by the Senate to provide coordination and governmental oversight of that system, but it is not to be the system. And I think that the Supreme Court actually got that decision wrong in saying that this board should not be responsive to the president, because I think that resistance to short-term political control comes from that structure. You've got the monetary policy decisions of the Fed are made by a committee of 19 people, 12 of whom vote at any one time. 7 of them are always that board in Washington, but the remainder are these private sector individuals. And so you'd have to have a president who would be able to nominate and get confirmed by the Senate at least 6 people on this 7-person board that strongly agreed with him on the direction of monetary policy. Trump tried that in his first administration, couldn't get most of his nominees through a Republican Senate. After his first handful, Jay, me, Rich Clarida, Mickey Bowman, he then put forward a number of others that he wasn't able to get through. So I think that the Fed board should be responsive in the same way that the rest of the executive agencies are after this decision this morning, but that its resilience, its resistance to the president, therefore being able to control the direction of its policy, comes from the fact that it is largely a private sector body, not a government body. So that's a little bit of a eccentric view that doesn't make the president happy, because I do think he shouldn't be able to control the direction of the Fed's decisions. And it doesn't make my friends at the Fed happy because they like the Supreme Court's decision this morning that says the Fed is different and should be independent.
mm. Yeah, I mean, yeah, that's like a pretty, it's a very complex kind of answer to unpack. Just because you like, I don't know, just to, like maybe ask like one more follow-up on it. I would, if you could like elaborate more on like that nuance between like how you think that there shouldn't be again like that sort of short-term political sort of like swaying, but the Fed as a whole should also not be independent. If you could just like maybe elaborate a little bit more.
Sure. The issue with the Fed, that people have just as a matter of, we live in a democratic society.
Mhm.
And if you have appointed this body of people that cannot be affected by changes in the country's views on where monetary policy ought to be headed. So, it's a something of a truism. I absolutely agree with the view that short-term political direction of monetary policy is a recipe for enormous inflation, which is, harmful to everyone.
Mhm.
Uh, so you don't want that. The analogy I often use is that I tell my wife not to tell me where she has stored the potato chips.
Mhm.
And if I ask where they are, I don't want her to tell me. And I don't view that as a violation of my democratic accountability, because it's like I know that if she tells me, I will eat the entire bag. And that's sort of the situation with monetary policy. As a democracy, we've said, yeah, we don't really want to know we don't want to have control over the potato chip bag. Uh, Unless we've really, really decided that potato chips are what we want. And if we have, we ought to have the ability to locate that bag and eat some potato chips. And the theory of Fed independence is that no, once you've hidden the bag, you can't get it. Um, so in my view, if you said, look, the president, much of this structure is a private sector body.
Mhm.
over the history of central banks, it's a modern phenomenon that they have been nationalized by most countries and made part of the government. They all began as private sector bodies, and the fundamental purpose of the central bank is to stabilize the financial system, which is a, a really a private sector collective action problem. The banks together have said, we're going to create a bankers bank that we'll all be members of that can help us stabilize ourselves in the event of runs and financial stresses. Uh, and there's a big public interest in that process. And so we have this board in Washington that provides coordination and oversight of this. But that mix of private sector and public sector um, roles is what provides the ability of that system, when the public sector says, we really want this, to say, I don't think so. But if you've really gotten to the point that a single president, has been able to say, I'm going to dismiss people from the Federal Reserve Board, I'm going to nominate these new people, and I can get six people who feel exactly the same way that I do through the Senate. If there's that degree of democratic agreement
Mm.
as to uh, that the Fed ought to change direction, I don't think we should be in a position of saying that that's impossible. We don't want it to be easy, but we can't make it impossible. And by saying that the Fed is independent, we've effectively made it impossible.
Mm. I see. Thank you. Thank you for sticking with me on that. I guess like now kind of shifting to a part that you actually kind of mentioned in your last answer. So you had your time at the Treasury, and then there was kind of this like little gap where you I think re-entered the private sector. So right around the financial crisis time, right around 2008. And then after 2008, you were actually appointed to become the first vice chair of supervision of the Federal Reserve, which was a role that was which was actually directly created out of like the Dodd-Frank Act and all of what 2008 was. So I'm kind of curious as to looking back on the 2008 crisis now, what do you think you understood differently being in the private sector and as an investor to than what you sort of later understood being a regulator and in your role as vice chair for supervision?
I wouldn't necessarily say that there were uh, different understandings. Certainly, I guess I would say um, in the run up to the great financial crisis, I was a supporter of the then new international capital framework for banks, basically, that was designed to ensure that banks had enough capital to withstand runs. The Federal Reserve had been a big uh, architect of that new structure. It was called Basel II. It was an agreement among the regulators of the world, bank regulators of the world, on a certain way of assessing capital. And the result was that you had capital at a certain level that was sort of even around the world, a level playing field, if you will, among internationally active banks. Um, with the great financial crisis, it became clear that that level was not high enough. It was not sufficient. And I, while I hadn't been part of the effort to develop that framework that we called Basel II, I completely agreed with it. I thought that it was, an intelligent structure, and it wasn't a dumb structure. It just did not result in enough capital in the system, and that it was clear there needed to be a lot more capital in the system. And then, one of the things we did, among the many things we did in the private sector at Carlyle in making investments in the wake of the great financial crisis, was recapitalize a number of banking institutions, realizing that they needed substantially more capital. So I'd say that's probably the principal change in my thinking as a result of the great financial crisis.
Mm. And then one of the other kind of notable things that came out of, Dodd-Frank and that whole financial crisis was the requirement for banks to begin conducting stress tests. So I'm kind of curious as to how stress tests are like, first of all, maybe you could just start it by explaining what stress tests are for our listeners. And then also how stress tests kind of looked from the perspective of the Federal Reserve and what they were used for by the Federal Reserve.
Sure. I mean, so the concept of a stress test is pretty straightforward, and it's not that it was an entirely new concept in looking at banks, but it has achieved uh, much more refinement and prominence in the aftermath of the great financial crisis, which is to say you look at a bank's portfolio of assets, the particular type of assets there are, you develop models to determine how each of those categories of assets would respond, where you would expect their values to go in the event of certain financial stresses. And then what the Fed does every year is that it articulates a scenario of assume the stock market has fallen X amount, assume that interest rates have moved in this direction, assume that the housing market, has had these developments. So a series of economic stresses, and you say, given our models, what do we expect happens to the value of the bank's portfolio? And therefore, given the amount of leverage that the bank has, because banks are very highly leveraged institutions, um, will the bank remain solvent? Does it have enough capital to meet its obligations if you assume this hit to its to the value of its assets? Uh, and that has been it was an extremely valuable tool in the great financial crisis itself because there was a lot of uncertainty about what the real value of banks were, uh, because people had clearly misunderstood that. It was like, oh, a bunch of things are happening that we did not think would be happening. The value of these banks' assets has collapsed significantly. Are these institutions still solvent? And by running really rigorous stress tests, the US was able to show, yes, they are, and sort of very promptly restore the ability of the system to finance itself because people had more confidence in which banks were solvent and which weren't. Uh, and then annually going forward, that has proved an important supervisory tool in ensuring that banks have enough capital, that we don't again get in a situation which we did under Basel II leading up to the great financial crisis, where a stress can happen and the banks don't actually have enough capital to fill their role in the financial system. That was particularly important in in 2020 when you had the COVID event, and you had a seizing up of markets and a big concern about if we have administratively shut down the economy, there are a lot of people who aren't going to be able to pay their banks. Are the banks okay? And that year, we ran 7 different stress tests. Usually we only run one, and we ran 7 stress tests over the course of that year, on various scenarios of, given what's happening, will the banks remain solvent? Uh, and we showed that they would be, and thus the US was able to allow its banks to continue to pay dividends even during the COVID event, because we said, assuming some pretty serious hypotheticals, the banks will still have enough money to pay these dividends. Whereas in the UK, in Europe, in a lot of the world, the regulators just cut off the ability of banks to pay their shareholders until they could figure out what was going on. Because we had this robust stress testing mechanism, we were able to say we have a pretty good handle on what's going on. And because we allowed our banks to continue paying dividends, their cost of capital today is materially less than those in Britain and Europe, because investors say, if we invest in a US bank, they're going to sort of very analytically determine whether the banks can pay their dividends. And in other parts of the world, they may just panic and cut off our ability to get paid at a time when we may need the dough. And so we will invest on more advantageous terms. We're more inclined to invest in US banks than elsewhere.
Hmm. Then our next question is actually kind of about the 2020 crisis, which you got at in your question. So, in 2020, we saw this sort of external event kind of spill over into the markets and then the broader economy. So, I'm kind of curious as to, how um, or what did that kind of moment show you about, just how quickly some of these problems that, might seem tangential or external can spill over into the broader economy? Obviously, with the pandemic, there were kind of those almost like self-evident things that happened to supply chains, etc. But I'm still curious as to if there were any lessons from 2020 and spillover effects that were there.
Yeah, so I think the principal lesson that I drew from 2020 is that there can be kind of black swan events, uh, quite consequential, that significantly disrupt markets. And while I'm, basically a libertarian and want to limit the amount of kind of government official sector intervention in markets as much as possible, there is absolutely an appropriate role uh, for a central bank to intervene in markets and not just by affecting sort of macro variables such as the interest rate in order to keep them functioning, which we did in a big way in COVID. The Treasury market, which is really the most important financial market in the world, had essentially seized up because people were looking at it and said, well, if we're administratively closing down the economy, I need some money. And so everybody was selling their most saleable assets, which were treasuries, and there weren't any buyers for them. So the Fed had to step in and be the other side of that trade, and that in an emergency like that is an absolutely both necessary and appropriate role for the Fed. Um, I think after the initial uh, emergency was over, we allowed those asset buying programs to go on for too long, and we should have tapered them sooner. But in the emergency itself, that was a critical function of a central bank.
Hmm. And then, like going back to our previous question on stress tests, obviously, as you mentioned, there are these sort of black swan events that can happen. So I don't know necessarily that a stress test would be able to, sort of accommodate or allow for or yeah, just like expect those sorts of events. So how does the Fed prepare itself for those events, and maybe what has changed in the Fed's preparation for those events since 2020?
Yeah, so you're absolutely right. I think you have academics sometimes, or you have some policymakers who argue that you ought to take account of, really unexpected catastrophes in running the stress test, and that banks ought to be able to withstand uh, really unexpected catastrophes. So if you sort of look at the sort of capital level that results from different types of stress testing analyses, the Bank of England assume we have another stress that's similar to the great financial crisis. We'll run our stress tests to ensure that banks have enough capital to withstand that. The Fed assumes assume we have a stress that's about 1.5 times our, in our analysis. Will the banks have enough? How much capital would banks need to withstand that? And our stress testing process puts us kind of at the low end of that range of what you'd need to withstand 1.5 times. And I don't know that they've re-engaged on the question, but a few years ago, the Federal Reserve Bank of Minneapolis ran its own separate program saying, assume you had a financial crisis that was several times the size of the great financial crisis. Well, the banks need much, much more capital than they have. And my view on that was, again, when I was a young lawyer, I had over-engineered a particular contract, and the partner on the deal told me, we don't need a lot of these provisions. A pig could fly in backwards through the window in a helicopter, but we don't need a provision in the contract to contemplate that. And similarly, I don't think we can run a financial system that assumes that something might happen once every 1,000 years, is you have to be prepared for. Instead, as you indicated, the Fed has, a series of emergency response tools for something that is outside the expected level of stress, which the COVID event certainly was at the outset. where you can intervene in markets in order to ensure that markets are responding, markets are continuing to function, that people can have confidence that they can get the cash that they need. You can provide liquidity, including to entities that might not otherwise be able to get liquidity. And the Fed has developed a series of mechanisms in order to be able to do that, including this last time during COVID, we created a number of facilities to do things that the Fed either hadn't ever done or hadn't done since the Great Depression, to provide liquidity directly to aspects of the real economy and not just the financial system, to corporates, to municipalities. And while I have some reservations about those innovations, that is the sort of thing that a central bank can do and should be prepared to consider, as opposed to try to engineer a financial system that could withstand such a shock without those extraordinary measures.
Hmm, makes sense. And I think for our penultimate question, we'll transition to a little bit more like your international kind of exposure and experience. So, as chair of the Financial Stability Board, you had to think about risks across the world globally and not just inside the United States. So, was there sort of a moment that maybe you can look back on, or an example of a policy measure that you implemented that was really a testament to just how sort of interconnected financial systems across the world had become, or if maybe you think that they aren't actually as interconnected as maybe they're sold to be, that also would be a pretty valuable insight. So maybe you could start out by just talking about first of all, what the Financial Stability Board is and things like that, what your role looked like, and then get into that question. That'd be great.
Sure. So, one of the things that happened in the aftermath of the great financial crisis is that the group of 20 nations, which are the 20 sort of principal economies around the world, got together and said one of the flaws in the international financial system is that we have not really created any sort of a mechanism for global coordination and interaction on financial questions. We have the UN, we have the World Bank for development questions, we have the IMF for emerging country finance questions, we have the World Health Organization, but we have the World Trade Organization. We didn't really have a similar financial body. So the Financial Stability Board was created, which has participants from both the central banks, but also financial regulators, bank regulators, non-bank regulators from all around the world, that meet to consider questions of global financial stability and where there can be improvements, to make recommendations as, again, to how each of the world's financial systems can improve their financial regulatory structure in order to support global financial stability. That's easier said than done. That's a very difficult diplomatic task. You've got to get people to agree on where the financial stability risks lie, and then you've got to get them to agree on how to address those risks. And as the distance has grown from the great financial crisis, that consensus both on the nature of the risk and the way to address it grows more and more difficult to achieve. But I think really one of the high points of the Financial Stability Board was in 2020. It was during the COVID event, and it was something that hadn't really been envisioned as part of what the Financial Stability Board would do. It was envisioned as a body that would make recommendations for prudential regulation that would forestall future crises. In the event of this crisis, which it really would have been difficult for any financial regulation to have forestalled because it was totally exogenous to the financial system, uh, you had, however, created these networks of communication, interaction, and coordination all around the world that didn't exist before. And during particularly the most intense initial months of the COVID event, uh, there were multiple long meetings daily among various regulators exchanging information about what was happening in different parts of the financial system around the world, exchanging views about how they ought to respond, who was doing what. Uh, and that all played a much more important role than anyone has realized. It's kind of like the dog that didn't bark in the night. The financial system didn't have any huge consequence. Now, some of that was because of, had these massive fiscal responses, probably overdone, at least in the United States on the fiscal side. Uh, but a big part of it was the fact that you had this network, this body that had been created to ensure that the global firefighting on this wholly unexpected event was being managed well, and it was managed well. So I think that's probably one of the things I'm proudest of really during my public service career, and certainly during my chairmanship of the Financial Stability Board, was that happened. Although I have to admit that it wasn't something that I engineered or planned for. It grew spontaneously because this body existed.
Yeah. And then I think for our final question, not to put you on the spot, but again, we've talked like about your various roles across the financial system, both private and public. So I'm curious if you can almost pinpoint a sort of lasting insight that you think either students or young people entering the economy should have in mind as they interact with these sort of larger forces that are going to shape their future, or just something that you think people might not think about enough, or yeah, understate the value of when it comes to the financial system.
So I really think, particularly for young people who are thinking about the financial system, in whatever capacity, whether because they want to become deeply involved in it as part of their careers or just how they'll interact with it in saving and investing over the course of their lives. I think something that most people who have spent a lot of their careers in the financial system realize, but that I certainly didn't realize when I was young and just beginning to be engaged in it, is that money and finance is not just numbers. It is fundamentally a set of promises. And those promises only work because people and institutions and laws exist to ensure that they are honored. And every part of the financial system is built on that trust. So the financial system is a human and political system with a small p, not partisan, but a political system with a small p first. It's a mathematical one second. It runs on incentives and governance, and therefore markets and governments and regulators are all deeply intertwined. And that's something that, given the different chairs I've sat in over the years, I've really come to understand and appreciate. You really can't understand the markets without understanding the rules and the regulators and the politics that shape them. And you really can't uh, act as a regulator without thinking really subtly um, and on the basis of good information about how humans will react to the incentives you're creating through your actions. So, uh, that I, and if you think about it again, just participating as a citizen, you think about the financial system. One consequence of all of that is that the risk in the system is about these connections. It's not really about bad actors. Every crisis, and there have been a number of them during the course of my career, it rarely comes from a villain. It comes from many institutions following incentives, in many cases, incentives that were created for them by the government in a network that nobody is fully managing as a system. It can't be fully managed as a system. Uh, and therefore being highly sensitive to where those incentives lie and how they can be affected, is a big part of thinking about finance.
Thank you. Thank you so much, Mr. Quarles, for joining us today.
Thanks for having me. It was a great pleasure.